The IAASB has introduced a standard for the audit of less complex entities. Before we have a look at what the AAA examining team says about this through its technical article, let's first understand what less complex companies are. They're basically businesses that are smaller and simpler in how they are run and how their finances work. So, for example, an owner-managed company would generally be a less complex business. Similarly, organizations that have fewer lines of businesses, simpler transactions, and relatively more straightforward accounting systems could all be classified as less complex. In short, these businesses are small, they are not heavily regulated, so the audit itself does not need to be as detailed with complex procedures as compared to the ones which are used for bigger companies. Now, the IASB has created this separate standard to make the auditing simpler and more efficient, and this is all done without compromising on the quality of the audit. So a very important point to remember is that our stages of audit do not get decreased. The audit work is scaled down to match the size of the entity. Before we look at the details of what could potentially be covered, let's have a look at what the examining team has clarified in the technical article. So they have said that you could be asked to discuss the purpose, content, or benefits of this ISA. At the engagement acceptance stage, you may be asked to see if the application of this standard would be suitable. So is this a less complex entity? Can we actually apply this standard over here? In quality management question, you may be asked to assess or critically evaluate whether the standard has been inappropriately applied. And remember, for exam questions, the examiner will always make it clear where the entity has to comply with relevant thresholds which are given by the local laws or regulations. So if there is a threshold which is prescribed by the local law that would be given in the scenario, there's nothing that needs to be learnt. So in this video, we are going to look at each of these areas and we'll wrap it off all up by coming back to this towards the end. Now, starting off with the first one, in the AAA exam, if you're asked to discuss the purpose and objectives of this ISA, you can talk about a number of things. So the standard is based on the same core principles as the main ISAs, but it is scaled down to suit simpler or smaller businesses. This means the audit steps are right-sized, they are practical, and they are appropriate for the company's size and complexity, so they're not overly detailed or burdensome. Secondly, the audit will still focus on identifying and responding to areas with a higher risk of material misstatement. Auditors are going to use professional judgment to decide where to focus their work. They will make sure that attention is given to what really matters most in the audit of this particular client. The goal is also to reduce any unnecessary paperwork compared to the full auditing standards. However, it's very important to keep in mind that auditors must still document enough evidence to show how they've reached their audit opinion or conclusion. So all that documentation requirements are still there. It's only the excess or repetitive documentation that is reduced, not the quality of evidence. So auditors will still be obtaining sufficient appropriate evidence the way they normally do this. So in terms of when this standard can be used, it really depends on your country or the region. So auditors can only use this if the local regulators or standard setters have officially adopted this. Remember, even though the standard explains which audit it is meant for, auditors would need legal or regulatory permission before applying it. So basically, you can only use it if your country allows it and for the types of audits it's designed for. What you see on the screen right now are companies which cannot be classified as less complex. So at the acceptance stage or in quality management questions, if the audit team is classifying these companies as less complex and applying this standard, you would pick that up to say this has been incorrectly applied, sorry. So starting off with the first one, listed companies are not less complex. We know what they are. Their shares are traded publicly, so they can't be less complex. Any other public interest entity like banks, insurance companies, large pension funds, etc., cannot be classified as less complex. And very, very important, if any component of a group is listed or public interest entity, or if its component auditors are going to be materially relied upon for the group audit procedures, this group or this audit cannot be classified as less complex. So even if the parent company itself is not listed, if one of its components like subsidiaries, joint ventures is, this cannot be a less complex entity. To evaluate if a company or a business given in the scenario can be classified as less complex, the characteristics on the screen need to be evaluated. So starting off with the first one, if the business operates in a simple, straightforward industry, there are going to be lesser risks that affect the whole business. Regulations are going to be easy and it would have lesser revenue streams, then it could be a less complex business. The business would have a simpler structure, not many layers of management, so a small management team with simpler reporting lines. The ownership is going to be clear and the company would not be a part of a complex group or a holding company. Less complex entities would have a smaller finance team, which is often centralized, so tasks and responsibilities would be easier to understand. Now, in terms of information technology, such businesses would use basic standard softwares without a lot of customization. Access to these IT systems would be restricted to a limited number of authorized individuals only. Now, in terms, and this is important for AAA, in terms of complexity in the financial statements, there would be lesser areas that require a lot of judgment, and there would be less complex calculations, models, estimates, etc. We're not saying there won't be any accounting estimates at all. We're just saying that they will have lesser uncertainty and complexity. So more predictable estimates with lesser uncertainty. So in short, a less complex entity is really one which is simple, transparent, and easy to understand, and this would make a scaled down audit more appropriate. If the examining team is in a good mood, you might be asked to discuss the benefits of using this standard for the audit of less complex entities. What you see on the screen right now are some ideas from the technical article. Because the client itself is less complex, the audit will become simpler. So, for example, auditors will still understand internal controls and test accounting estimates, but this will be done in proportion to the risk and complexity. It is very important to remember and understand that this does not remove the essential work needed to form an opinion. So, the stages of audit will still be followed. Auditors can adjust their approach to fit the size of the client and how complex their operations are. Auditing by using this standard will save time and cost for both the auditors and the clients. It will make it easier for smaller firms or smaller clients to get a high quality audit. And the best part in all of this is that the quality of audit work will not be compromised. Remember, this standard works within local regulations and standards, so users can trust the results because we have complied with the local laws as well. Just to bring you back to what we started off with, the AAA examining team has clarified that they could be testing you on a number of areas regarding this topic. You might be asked to explain the purpose or benefits. You might be asked to decide whether this ISA has been correctly applied or this particular client has been correctly classified as less complex. And you might be asked to identify potential audit problems when this ISA has been used inappropriately. So, for example, for the audit of a less complex entity, if the audit team has decided to skip some substantive procedures simply because it's less complex, you are going to identify that to say that is incorrect. This ISA does not say the key stages of audit have to be skipped or missed. You're just scaling down the amount of work.